everybody, it's Mr. Wagstaff. Cool stuff to talk about today. So today, as we're continuing our unit in economic and personal finance, we're in the 7th unit, talking about credit and debt. Today we're going to start talking about how to invest and start to actually build wealth. And we'll talk about how that connects with credit and debt here in just a second, but let's go ahead and get started. So we've spent this entire unit so far talking about how to alleviate the catastrophic chasms that can be credit and debt. Credit can be used beneficially, debt also beneficial, that how to navigate all the negatives of it. Well, say you've done that and you have you get to a point in life where you have been able to been financially responsible. Typically, if you've been financially responsible, the chances of just living paycheck to paycheck are very slim. If you're financially responsible, you're actually going to have some additional money. And at that point, what do you do with it? And that's what we're going to talk about today. Investing and what to do with your extra money, because if you've been financially responsible, you can invest it and you can use your existing money to make more money. So let's talk about that. So this is talking about building wealth. When taking your money, having your money work for you, and making more money off of your existing money. So typically this is how it works in life. If you've been financially responsible, meaning you haven't got yourself into a cycle of debt, and you've lived like that long enough, all of a sudden it is going to kind of catch you off guard unless you are making, 6 figures early on in life. You're like, wait a minute, I'm actually pretty good here. And you probably wouldn't expect this when you're in your 20s, early 30s, again, depending on your unique situation. But if you have avoided any catastrophes, and you've done that by being smart with your money, then you start having some extra monies and you can use that money to invest and make additional money. So that's what we're going to talk about today, different ways of investing your money. So as you're building wealth, here's some investment strategies. All right. So one of the most common and I say common, it is probably one of the more secure ways of investing it's called the buy and hold strategy. Basically, you purchase something that's going to increase in value and you hold on to it for a long period of time, and then you sell it for a profit in the future. If you're thinking about like stocks, you think investing in investing in stocks. You would invest in what's called like blue chip stocks. These are companies that have kind of stood the test of time. You're not going to get rich overnight, but if you put your money in them now, they're going to gradually get better over time. And 10, 15, 20 years from now, you're going to have a whole lot more money than you ever put in. It's not really something that you get rich overnight on, but it's the buy and hold strategy. Other examples of a buy and hold strategy is real estate investing, because real estate like houses and things like that, they increase over time. We're going to talk more about that here in a second, because most of what we've been talking about in this course is like trying to get yourself a house, if getting a mortgage and all the things that go into that. And then you're like, are you talking about buying extra houses? Like, how rich do you think we are? We'll talk about real estate because that's a whole separate type of investing, but it can also fall into the buy and hold strategy. So we'll come back to real estate in a minute. Bonds, government bonds. That if you invest in these government bonds, that the government is relatively consistent. The United States money is relatively firm over time, and you invest in that, and that's usually a pretty good guarantee that over time, when you cash out, you'll have a pretty solid profit on that. These are much lower risk. I should also point out there is no risk free in investing. You put your money in something, it can disappear. It can. Buy and hold is usually, if you do it smart, is the lowest risk possible, and it's usually a very, very, very small risk, but you are still taking a risk anytime you invest in something. Now, there's another one I didn't have up here, is gold. Gold historically has always increased in value because there's a finite amount of it. So investing in gold is actually a pretty solid buy and hold strategy. So why? What's the benefits of buying and holding as far as taxes go? So if you are buying and holding something for a long period of time, you pay less taxes than if you were cashing out like every year. If you have, in this example, you have $5,000 profit, short-term capital gains. So capital gains are the profits you make off of your investments. In the short term, you're doing it in less than a year, you can get taxed at like 22% of that. If you do it over the long term, when you cash out, you're only taxed at like, according to this, is 15%. So it is much cheaper. You pay less taxes if you wait a long time before pulling your money out. This is the government's way of encouraging you to put money into the markets and allow the economy to grow. All right, let's talk about a whole nother type of investment strategy, an index fund. So this is more complicated than buy and hold. So if I go into too much detail, this will take a 5-hour lesson, so I'll try to simplify it. So an index is a collection of companies, like in stocks, that you would invest in. But it's not just any companies, it's all the good ones. So if you took, like, these are the top 10 companies here, based on their market share, you divided all your money up and invested in all of these companies at the same amount that they represent the market, all right? That's an index fund. This is, unless the entire stock market collapses, which it shouldn't, I'm not gonna say won't, shouldn't. It happened in the Great Depression, and we learned how to make sure that never happened again. So it should never happen. That you divide up all your money among these companies, even if one of them does bad, the other ones are historically going to do well. So this is a very safe way of investing and diversifying your portfolio across the board so that your money is as safe as possible and slowly grows. It's very low risk. You get a tax advisor or a financial advisor that can tell you what to do, or get a broker that can do it for you and they get a percentage. It's very easy, low risk. It's diversified. One company struggles, the other ones keep your profits coming in at the end. The downside is this is not a get rich quick thing at all. Not that that's a bad thing, but it's not going to outperform the market. So you're only as good as the market as a whole. So the question is, what is the tax implication for holding stocks for more than 1 year under the buy and hold strategy? So we had talked about that. So pause me, answer that completely, and we're moving on. All right, other types of investing. Let's talk about dividend investing. If you've ever heard somebody say, hey, like, you put in the work now, it'll pay dividends in the future. That is a reference to this type of investing. So there is an actual type of investing which you can invest in certain companies that pay dividends back to you. Meaning that some companies, like Apple's a big one, Microsoft is one, that when you invest in their company, once that company starts doing really well, they actually give cash to the people who own stock in them, kind of as a thank you for buying stocks in us. They obviously do this so that people want to buy stocks in them because they can get money back. It's like free money. You still have your stocks, the stocks are still increasing, and you get extra money. And that extra money that they give out to their stockholders are called dividends. They do this obviously because they desperately want people to invest in their company so that they have capital to grow their company. But if you have a lot of stocks in companies that pay dividends, it's very much what's referred to as passive income. You're getting money for not really doing anything because you made the smart decision in investing in those companies. Not only that, stock dividends, there's certain ways that you don't even pay taxes on stock dividends, and the taxes that you do pay are only in certain situations. But no matter what, when you get tax dividends, even though that's income, that still gets taxed at a lower rate than income tax. So people who are really, really smart with their money and have a good amount of it and have created wealth, and they invest in stocks that provide dividends, can pretty much live almost exclusively off the dividends that they receive. And even though that's income, they still pay less taxes than somebody that's actually working for their money. Crazy how that works. So dividends are always going to pay at a lower tax rate than actual income. So let's talk about value investing. So value investing, this is kind of the get rich quick thing, all right? If you're super smart and you're going to spend all day looking at stocks, this is where you can make some money. You could also mess up pretty bad here, all right? But a lot of people, Warren Buffett, super famous at doing this. Basically, they just scan the stock market and they have a very good understanding of these businesses. And businesses go up, their prices fluctuate all the time. The trick is to find when a company is being undervalued. And it happens, all companies are fluctuating all the time. If you can buy a bunch of stock of a company when it is underpriced, then you can turn around and sell it when it goes above the intrinsic value. And you can make a ton of money very quickly by doing that. However, if you buy all the stock when it's overpriced, all right, you could lose a bunch of money. But again, even if that happens, you just hold on to the stock. Historically, most things, if it's a reputable company, will eventually grow, but it could be years down the road. But value investing is finding those companies that are selling their stock for less than you know it's actually worth, buying it then, because once the market realizes that, their stocks will skyrocket and you can make a huge profit very quickly. It's risky, but it is an investment strategy. So the question here is, what is the tax What is the tax implication for qualified dividends under the dividend investment strategy? So we talked about that. So pause me, answer that completely. We're moving on. All right, so in the buy and hold strategy for investing, we talked about real estate. Let's come back to that. So investing in real estate is a very common and historically a very successful way of making making money. So obviously you would have to take a mortgage out. You have a house, right? But then you take a loan out and you buy a second house. Now you took a loan out. You're in more debt, all right? That's a house that you don't live in. So you still have to pay the bank back all the time. Like, okay, Mr. Rex, if you just put us in more debt, this sounds like a bad idea. If it's a rental property, what you do is you rent that second house out to somebody, but you charge them more than what your mortgage and everything it takes to keep the house up, which is like property tax, because you have a lot of expenditures that you have to pay to upkeep a house, as we've talked about here. So having a second one is twice the expenditures. This is one of the reasons that rent is going up so much around the country, is because property taxes, the hourly cost of plumbers and electricians and these other people to come fix things, all of that is increasing. All of those expenses get passed on to the renter, and then at the end of the day, there's a little bit of profit in there, probably just a couple $100 of profit for whoever owns that house and is upkeeping it to be able to make a profit after they pay off all the bills. So a lot of people who invest in real estate, and that's their primary thing, they actually buy a bunch of properties, all right? And they rent them out to a bunch of people, and they're called the landlords, and their job is to make sure the house is upkeep. There's all these laws as a landlord, all these things that you have to do in order to have your house livable for other people to live in it and pay you rent. So there's a huge amount of responsibility investing in real estate. There's a lot of property taxes, there's expenditures, you can be in a lot of debt, but they're paying it off. But there's a lot of benefits of real estate. When you do your taxes, there are so many built-in, like on purpose, we call them loopholes. They're not really loopholes, they're benefits, such as the concept of depreciation. So houses always increase in value, but on taxes, they just pretend like they don't, and you're allowed to deduct the depreciation of the house that you are renting out. It's getting more complicated, but being able to count depreciation really helps you in tax time and not have to pay as much taxes as you would think. You have the rental income is a benefit. The appreciation of the actual house, like in the real world, as you have purchased it, it is still increasing in value. Historically, real estate always the cheapest real estate will ever be is right now today. That's kind of true forever. That it will do nothing but continuously increase in value over time. So while you're claiming depreciation on your taxes, in real life, it's appreciating and increasing in value. capital gains, live-in flips. There's all these other variables here that are more unique, but real estate is probably one of the most common investment strategies because people understand houses and that people need to rent them and how that works. So real estate in itself is a very, very common investment strategy. And people make their full-time jobs out of it as well. So what is one pro and one con of real estate investing? So pause me, answer that completely. We're moving on. All right, so we have talked a lot about having your financial plan, having a budget, having all these things organized and set up, all right? Now here's a thing that I can't really teach you that you would have to learn on your own, but I just got to prep you for it. Life happens. It's going to happen. Good things, bad things, unexpected things, expected things. Things happen in life. And you got to roll with the punches. So when life happens, it can change your financial plans really quickly. You could have the clearest cut financial plan laid out for your 20-year plan, and crazy things can happen that forces you to have to sit back and adapt your financial plans to life. So here's some of them. Income change, all right? Obviously, the simplest one, you got laid off from work. You don't have as much money now. Your financial plans are going to take a hit. What if you win the lottery, all right, and you have $50 million? Your financial plans are going to change. So we have these financial plans, but they have to adapt to life situations. Budget change. Your budget is going to change for a variety of reasons. So you have a certain amount of money that's coming in. If your income doesn't change, but then all of a sudden you have a sick parent you have to take care of, you had a kid, you have to learn how to pay for childcare, that this budget that you had that worked really good for years, all of a sudden you have to like rearrange it and really change your budget. You have the same income, but you have more responsibilities. And so when, life gives you lemon, make lemonade kind of thing, your budget's going to change and you have to adapt to the stuff that life throws at you. Another thing that really can mess up a budget and your financial planning that happens in life is the cost of living. So like inflation is that the value of the dollar goes down, so it takes more dollars to buy the same thing. So what happens is the cost of everything in life gradually goes up. Gas is going to go up, groceries are going to go up, taxes are going to go up, the cost of houses is going to go up, rent's going to go up. Everything is going to gradually increase, and your budget has to adjust for that. This can be very challenging if you're on like a fixed income, but cost of living changes are very, 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 I don't want to say catastrophic, detrimental, impactful on a budget and financial planning. So the cost of living is the term used for how much does it cost to continue the same lifestyle next year as it does this year. So if the cost of living increases, all that means is to live the exact same way you are right now is going to cost more money next year than it does this year to live the same lifestyle. And the cost of living is always going up. So the question here is, what does the cost of living refer to when it comes to financial planning? So pause me, answer that completely, and we're moving on. All right. So, continuing here with life influences on financial planning. So, here's some other stuff that impacts the way you deal with your financial planning. Experience. This is a huge one. If you grew up without a lot of money, that is an experience that you had that could really manifest itself in multiple ways. You could be very frugal yourself because that's how you grew up. You could also say, I'm not going to live the same life I had growing up. I'm going to spend my money. And you're much more willing to spend money because you didn't have things growing up, especially you have kids. I want my kids to have things I didn't have. There's definitely pros and cons to that. But your experience, if you went through a rough patch and you thought everything was going good and then you lost everything and had to start over, you might be more frugal with your money moving forward after that. So your life experience really changes the way in which you deal with financial planning. Another thing is your life goals can change. When you are young, remember, all I want to do is move out of my parents' home, get my own house. That's how I'm going to budget. I'm going to save up for a down payment for the house, and that's your entire budget, your entire financial planning. Then you buy a house, and you accomplished your goals, and you're 30. Okay, now what? You create new goals. I want to be able to have a vacation house. I want to be able to set money aside to pay for my kids' college. I want to open a 529 account. I want to do all these other things. Your life goals change, and that will change the way you budget and the way you financially plan. Other things, economic conditions. When the COVID pandemic hit in the United States in 2020, absolutely just shut down the economy. A lot of people lost their jobs. It threw a huge monkey wrench in everything, and everybody really had to reassess their financial plans. Economic conditions are things outside of your control. This can lead to layoffs. This can lead to all types of stuff and can drastically impact your financial planning. If you've invested in the stock market and the stock market, all of a sudden the economy does good, you might have all these additional dividends coming in. You might have all these other things, and this extra influx of cash also changes your financial plan. So economic conditions aren't necessarily good or bad, but it is definitely something that impacts your financial planning. And here's another one that we haven't talked a lot about, but I felt like at least in this course you should hear this word one time: bankruptcy. Bankruptcy, so bankruptcy, what this means is, say you have a business and you put all your money into this business and you took out all these loans in the name of the business, and the business failed and you owe $200,000-$300,000 for this business, a restaurant, whatever it is. And you're like, I clearly can't pay that, and the business has collapsed. In the United States, we allow something called bankruptcy. Bankruptcy says you go and say, hey, I can't pay my debts back. I can't do it. And I'm oversimplifying this here. The bankruptcy is basically wiping it clean. There's different versions, different chapters or different types of bankruptcy, but bankruptcy basically just starts over. It's like, okay, fine. Very lenient in America because America wants people to be able to start businesses, and if they fail, they don't want them to their life to be over. They want them to try another business in the future. Bankruptcy is a legal process in which you don't have to pay your creditors back. Now, everything that you own is pretty much getting taken. It is starting you over at zero. Your credit score is going to be crushed. Basically, anything for that business is gone, and you start back over at zero. But starting back over at zero is a lot better than starting back over at negative $300,000. So bankruptcy is an option used in America to encourage people to start businesses. That the worst case scenario is you all start back over at zero. But you have to be really smart about this in advance, because if you've taken everything out in your own name, bankruptcy laws don't necessarily work the same way for personal as they do for business. But bankruptcy, obviously, if you have to file for bankruptcy, it will change your financial plans because you're starting back over at zero. So the question here is, during times of economic uncertainty or recession, what might people need to do with their financial plans? So we talked about this quite a bit. Pause me. Answer that completely, and see you guys tomorrow.